Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about leases and specifically about the accounting for lessors. And we've been working on our very first example of lessor accounting. And we've talked about the steps, we've done an amortization schedule, we've talked about the three different kinds: sales type, direct financing, and operating, including the fact that direct financing is a little beyond what we have time for, but it would be something that you'd need to look up when you get that external verification or guarantee that the leased asset is going to be worth what the lessee promises it's going to be worth, or what the lessor expects it to be worth at the end of the lease. Then last time we got to start doing the journal entries, and we had so much fun going through and doing those entries, but I stopped myself and I let you work on the entries for year 3, and hopefully you've already done those as we move forward into this next segment. So we're going to jump right in with a review of those entries, and then we'll talk about what happens in year 4 as we wrap up this lease. So let's look at these entries, and we'll start with the sales type lease. In January, we would have recorded cash of $56,825 coming in. We would have used that to reduce our net investment in lease, since they're paying off this receivable that we have from them. And then on December 31st, we would have shown that interest revenue. And again, that number comes straight from our table, $5,884 of interest that would have accrued over the course of the year. Then, to finish off the sales type lease, we would also have looked at our T account. So we would have started with $203,920, paid off $56,825, accrued extra interest of $58,884. So we end year 3 with a balance on our balance sheet of $152,979. For our operating leases, as we mentioned before, the entries look exactly the same as they did for years 1 and 2. These entries don't change if we use straight line depreciation. So sure enough, there's our cash coming in, but now it's rent or lease revenue. Then we show our lease expense and amortize away $1,000 of those deferred initial direct costs. And finally, we have our depreciation expense or accumulated depreciation. You can also call it amortization if you want to, but it ends up being that same $40,000. Hopefully you got those entries all right and you're feeling comfortable with the way these entries are made. I'm going to invite you to go ahead and make the same set of entries for year 4. Don't worry about the asset coming back, which it will do at the end of year 4, but just do these basic entries, and then we'll talk about them when we come back in just a second and move on to what the entries would look like when the asset actually comes back. So pause the video here and give those entries a try. Hopefully you're still feeling really good about this. The entries are pretty straightforward and simple. Let's take a look. We've got the same amount of cash coming in, $56,825 on January 1st. And then we've got much less interest that's accruing, but we're still accruing interest because they still have that $100,000 asset that they have to give back to us. Here's our T account, and this time I thought we'd do the calculations together because this T account is going to be really important to us as we wrap up the accounting for this lease and get the asset back. So let's go ahead and show the $56,825 that was paid and the $38,46 that's come in. And I'm going to go ahead and put a line in there because this isn't our ending balance. This is the balance as of the accrual of the interest, but we're still getting that asset back. So this won't be the final set of entries for this sales type lease. If you do the calculations, if you calculate this almost ending balance, we end up with $100,000. And that's exactly what we should end up with. It should be exactly what we have as our residual value. If not, then we've done something wrong in some of our earlier entries or in the way that we've recorded them in the T account. But it should end up at that $100,000 because that's what we're assuming we're going to get back as this lease wraps up. The operating lease entries, pretty straightforward. They look exactly like they have every other time. That's why operating leases are so popular. from the lessor standpoint, because not only do we get to record a lot more revenue, almost $57,000 a year as opposed to $5,000 or $6,000 in interest revenue, but we also get to have these really simple entries that look the same every single time. And that makes the accounting very straightforward and simple. And that can be very nice as well. Now, in order to wrap up year 4, we need to do the entries for the receipt of the asset. So let's take a look at that. We'll start with the sales type lease first. We're going to get the asset back on December 31st. So for a sales type lease, we're going to put it back where we got it. So we originally recorded this as equipment. That was our initial credit when we gave this asset to our lessee. And we think that's worth $100,000. Then we'll credit our net investment in leases. And this is the return of our leased asset. So if we got it back and we looked at it and they'd worn it out more than we thought, it's only worth $80,000, then the entry would change this just slightly. We'd still record the credit to NIL of $100,000, but we'd only record equipment of $80,000, and we'd have a $20,000 loss that we have to record because this asset isn't worth what we'd hoped it would be worth. So we estimated and planned, and we've recorded interest and revenue, assuming we'd get back that $100,000, and we didn't, which is one of the reasons why we like guarantees. So that if it's not worth the full $100,000, then our lessee has to pay. Oh, here's the difference. I didn't treat it as well as I should have. Here's the money back. So we would get cash for that other $20,000 instead of showing a loss. But now let's wrap up our sales type lease by finishing off our T account. We have the $100,000 that we recorded coming in, and this balances out at 0, and we're done with our lease. Now for an operating lease, once again, the entries are even more simple than they are for sales type leases, because with an operating lease, we make no entry at all. Why? Because we assumed that we kept this asset. They have been using it, but we've kept it on our books, we've continued to depreciate it. We didn't record this as sold or gone. So we don't make any entry at all at the end of the lease. They bring it back, they drop it off. Physically, we get the asset back, but from an accounting perspective, it's still ours, has been ours, all through the whole lease period. So we don't have to make an entry at all. Just to wrap this up, let's take a look at what this would look like when we sold it. So let's assume that on January 1st of year 5, we sold the asset for $75,000. So we got it back. We thought it was worth $100,000, but when we went to sell it, we just didn't get the money that we'd hoped for. So let's take a look. We'll do the operating lease first since we didn't have an entry for them. We would record cash coming in of $75,000. We'd record equipment going out of $300,000. We have accumulated depreciation of $160,000. That's $40,000 a year for 4 years. And then we'd record a loss on the sale of this asset, $65,000. Sale of equipment. A little bit different for a sales type lease. In this case, we don't have any accumulated depreciation, and we have the equipment as being worth $100,000. So we'd record cash of $75,000. We'd record equipment of $100,000, and then we'd record a loss of only $25,000. And that's it. That's all the entries that we would need to record as the lessor for our sales type or operating lease. Isn't that cool? So much fun. Matter of fact, we're having so much fun, we even threw in extra entries, what it would look like to sell off this asset at the end of the lease term. That was just fun to compare what it would look like. I just can't help it. Extra journal entries, you got to do it. Of course, that's not our only option. When we get a leased asset back as the lessor, we don't have to sell it. We could lease it again and again and again and again until it either wears out or we find a buyer or we decide we want to use it internally or we just discard it because it's worthless. So lots of options as a lessor on what we do with a leased asset once we get it back. When we come back, though, it's time to move on and talk about some of the other issues that come up with leases. Lots of fun stuff to come. We'll see you then. Thanks.